Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Celsius Holdings, revisiting this one, did a video on these guys about a month ago. Stock is down 20% since then. At the time, I basically said that, hey, if you can buy into the growth estimates, if you believe in the brand, high 30s seemed like a fair value. Well, it turns out that the growth estimates were way off, and we'll talk about that in a second. One thing to note is that the energy drink category as a whole is struggling. Celsius, Monster, Red Bull, etc. They're not doing amazingly. And this is really the first time that some of those bigger players, Red Bull, Monster, have seen volume decreases since the last recession. And maybe that's a Red Bull indicator or a Monster indicator. The recession is here. But it's kind of a problem for all of these brands because energy drinks, maybe they're maturing. Maybe people just have less money to spend on $3 energy drinks. But at the end of the day, they're not doing very well. And Celsius is no stranger to that, which is why it's down 50% in the last year, quite a bit more since its all-time highs. We look at what's driving this, and it's really the way their business operates and what is driving their revenue. So essentially, they book their revenue when they sell to their distributor Pepsi, and then Pepsi distributes it to random stores, etc. So when you see the scan data that says, well, Celsius is still growing at 10% on the retail level, that's great, but it doesn't mean anything for their own revenue because their own revenue is based on when they sell to Pepsi. They book revenue and recognize revenue when they sell to Pepsi. And essentially what happened is when they signed this deal with Pepsi, Pepsi bought a ton of inventory based on the expectation that their 100% growth will continue for quite some time. So in 22, their growth is super high because Pepsi is buying a ton of inventory. In 23, the growth is super high because Pepsi's buying a ton of inventory. In 24, demand starts to slow down really quickly. And Pepsi still has a ton of inventory because they bought so much in 22 and 23. So it doesn't mean that the product isn't selling. It's just that Pepsi has too much inventory. So as they go into their buying for Q3 and Q4, they're buying 100 to 120 million less from Celsius versus the prior year. And I'll illustrate this another way. So think of the black line as Pepsi's orders. Think of the orange line as the demand curve. 21, 22, 23, Pepsi is ordering a lot. Demand curve is growing really quickly. The excess inventory that Pepsi has isn't that large. It's in the level that they're comfortable with. Then you get to 22, 23, and you start seeing the demand for the product on the retail level, whether it's because of the economy, convenience stores are seeing 4 to 5% less traffic, and a lot of these sales happen at the convenience level. Demand starts to slow down really quickly. And Pepsi has to readjust. Now suddenly they have a ton of inventory. This is their supply. The excess inventory, the line right here, the difference between the two lines, is a lot bigger than they're comfortable with. So as they go into their next ordering season, they look at a partner like Celsius and they say, we're going to buy a bit less from you. We're going to take this supply to a more comfortable level where we don't have that much inventory sitting in our warehouses. So now suddenly their orders are way down, which is going to mean that Celsius is booking a lot less revenue for the next quarter, potentially the next 2 quarters. Doesn't mean that the product isn't selling anymore because demand is still there. The product is still growing, but it's growing at a much smaller clip than Pepsi and really Celsius expected because Pepsi overbought, demand really dropped off, and now Pepsi is buying a bit less to get that inventory level back to where they want it to be. You know, they want more than the demand in terms of supply because they want some that they can supply when demand picks up. They don't want way too much because way too much is just wasteful on their part. So that's what's happening. Hopefully that's clear. If you have any questions, leave me a comment down below. But that's essentially what's happening. That's why the revenue expectations are really dropping here. Again, we went from mid 20% range to the teens, probably in the high single digits. Who knows what's going to happen in 25? But in general, Pepsi's orders are probably going to come down in 24, meaning that growth is going to really slow. It's not going to be anywhere close to 100%. And then the question then becomes, when does that stop? When does the demand supply equilibrium hit, well, the equilibrium, I guess. And I think these expectations for like 23% growth in 25 and 28% growth in 26, given that at the retail level, this is growing at 10%, are pretty optimistic. I think what you're going to see as we look at the valuation here, and disclaimer, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. I think what you'll see is that the revenue growth will slow pretty quickly. At least that's what I'm expecting. That's kind of my assumption here. I will leave a link to this spreadsheet down below. Hit file, make a copy. Again, the assumptions here were 20% growth down into mid-teens for the next couple of years. Now suddenly the expectation that the stock market has are potentially low teens growth at best. And maybe that's a bit pessimistic. Maybe it's going to be lower in 24 and then start picking up again in 25, 26, 27 as the brand gains traction, especially overseas. But I'm taking a more pessimistic view of this just to kind of outline what could happen if the growth really slows. You know, the negative thing about this stock, at least right now, is that they're diluting shareholders still. Stock-based compensation. I think what they should start doing eventually is, because they are producing free cash flow, and it's kind of hard to tell what their free cash flow is going to end up for 2024 because of this big reduction in orders from Pepsi. Start buying back some shares. Show that you believe in the value of the company. The stock is down 70% since all-time highs. Still trading at a healthy $7.5 billion market cap, but this is a company that has plenty of cash, is generating cash, and should do something with that cash, whether it's, again, buying back shares or reinvesting more in the business or whatever. But if you look at it this way, you know, you sort of look at something like a 10% growth with decently healthy margins. Is a 4% fair free cash flow yield fair? You know, at this point on a forward basis, assuming that this is all correct, you're getting about a 3% free cash flow yield on something like this. Based on their former assumptions, when it was running and growing in the 20% plus range, a 3% free cash flow yield is very attractive. But now that it's changed, is it a bit too aggressive? So as I look at this, 10% growth with margins that are about the same, not really improving, a 4% free cash flow yield in the future, get a fair value today of about $22. So it's changed a lot, right? This is the interesting thing about brands like this, and this speaks to some of the other videos I did about brands. The expectation, the demand for a product can change so quickly that the valuation can move from $90 to $20 within a matter of months, because suddenly you're not growing at 100%, you're growing at 10%. And that is a big drop off. And it's a drop off because the category is slowing, because there's more competition, because your product just kind of reached its maturity maybe. It's hard to tell with stuff like this. And because this is just one brand, one drink, you're investing a lot in something that's here today and could potentially be gone a couple of years from now. You know, when you invest in Monster, you can't invest in Red Bull, but it's there. You know, that's a brand that's sort of built up a cachet, that's shown that they have the power to stick around, that is already generating a ton of free cash flow. You should probably pay up for something like that. When it's Celsius, there's a lot more risk, and that's what worries me about stocks like this. That's where I get a bit more conservative with stocks like this. And again, I didn't buy in the 40s because even though on paper, based on those assumptions, it looked like it could be an okay valuation, you had to believe in the brand and the growth pattern that was ahead of it. And that's clearly not showing up in the results. And it'll be interesting to see what their Q3 looks like. It'll be interesting to see what they guide for in Q4, because it's quite possible that Pepsi's not done reducing their inventory just yet. If they way overbought here, you know, this is kind of like fake growth in that regard. They overbought based on based on demand expectations, and those expectations just aren't there right now. So if Q4 is also another reduction in revenue, is this optimistic? I mean, that's the kind of risk you're taking. However, if Pepsi is sort of done reducing their revenue by Q3 and this demand starts to spike up again, this is still sort of a leader in the growth of the energy drink space. You know, the energy drink space right now is flat. This is at 10% on the retail side. If that continues to be the case, could this get interesting in the mid-20s? Maybe. It's still not something I'd be super interested in, but if it, you know, keeps falling and it sort of starts getting into that like high teens range, which is not out of the realm of possibility given what we know about what Pepsi's doing with their inventories and this brand, then maybe I'd sort of take another look at it. For now, though, the announcement of, hey, Pepsi's reducing their inventory by 120 million, that scares me right off this investment. and it shows how volatile this brand is at the moment. And it kind of shows that, hey, this is, this maybe wasn't all real. This maybe was based on certain expectations that just didn't materialize. So again, disclaimer, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Let me know what you think. Leave a comment down below. Am I missing anything? Am I wrong about anything? I would like to hear your opinion. So comment, like, all of that good stuff. Bye.